Welcome back to Focus Fridays, the series where we open up the playbook on real estate investing from foundational concepts to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Shum, Head of Investor Relations here at Focus Capital, and we are joined yet again by our VP of Investments, Chad Olson. Chad, we spent the past two episodes going deep on debt, loan types, interest-only periods. Today, we're zooming out actually back to the macro level instead of diving even deeper, how interest rates actually affect real estate performance. This topic has been front and center for anyone who is in the real estate business or has taken out any type of debt. Over the last several years, rates have moved faster and further than most market participants probably anticipated, and the ripple effects through valuations, deal flow, cap rates, and returns, et cetera, have been significant, and even for some deals pretty severe. I would say that today we should break down exactly how interest rates flow through real estate at the deal level, the valuation level, and the portfolio level, and then what investors should understand about navigating rate environment and how that continues to evolve, even though that's not in any of our control, but kind of understand the process that we go through when it comes to evaluating rates. So at the fundamental level, how do interest rates affect our real estate investment performance?
And since interest rates are the determining factor in what our loans are going to look like and what rate we're going to have to pay back those loans, and because loans are, as we talked about in earlier episodes, 60 to 75% of the capital stack, it's a significant part to determine the cost of capital. And so from that, you need to use that baseline to determine, okay, here's the rate of return that I need to achieve on these assets. And then that goes into the valuation, right? You alluded to cap rates. It's like whatever those prevailing treasury rates are, there needs to be a spread built in above those for what cap rates are to determine the valuation that it is for any of these real estate assets across the board, because you're taking on degrees of risk for that. And so you need to be compensated for that. So it's kind of those two factors on like what is the risk-free rate, and then what is it based off that for your spreads, and then what kind of return are you going to need to get the property to be able to pay and service that debt while also still making money for yourself and the investors.
Yeah, I think the very first point that you made about cost of capital there, like if you increase the rate at which you're borrowing at, that's more expensive. That means that it comes directly out of cash flow available to investors. Yep. Like a $6 million debt piece at a 200 basis point increase on the interest rate means $120K more in annual interest expenses, and that comes directly out of cash flow. What about on the valuation part of like cap rate expansion? In a low rate environment versus a high rate environment?
Yeah, so in a low rate environment, we see what we saw in the last 5 years, but specifically the first 3 years after COVID. So if rates are down at the 2% and stuff, or zero negative for the underlying rates, and then with spreads, around 2% or so, you can pay very low cap rates and you can pay premium prices for it because it just makes sense and it works. And that's what people did. And then depending on the leverage that they took on, they got into trouble. And now we've seen rates move up to the 5s for A-class multifamily, and accordingly, there's still risk. That spread between where some people are paying cap rates on for assets and the underlying debt is tight. And so there is probably a natural thing. And we've seen it in the older vintage stuff. Going back to what I was saying with cash flows, it's like on the older vintage stuff, you can get it for the right basis. Well, even then that's a little strained, but your yield needs to be there to compensate you for the amount of CapEx spend you need to do and all this other stuff. And that's where we've seen the most problems, because people really did pay, 5 and 6 caps or less on those assets, these older vintage ones, thinking that there'd be this crazy rent growth, and took on bridge debt or bank debt. But now the valuations have moved to 7 and 8s or higher because of this spread difference. Value add, 80s, 90s, 2000s, core plus deals, those have stayed in. And I don't see them moving a ton, but they do have room to move if rates continue to go higher. Yeah. And so if those rates are moving up, then there's the spread that everybody kind of assigns to it, and those are going to move up accordingly as well. And people will start on the buy side pricing that in when looking at assets, and brokers will have to come to it and sellers will have to come to terms with it.
Yeah, and the quick arithmetic for people that are listening that are might be like confused on where that valuation comes from. You can have an NOI that's constant of like 700K, and then at a cap rate of 5%, that same asset's worth 14 million from a valuation math perspective. Obviously, much more goes into it, but as a top line math, if you jump up to like a 6.5 cap rate, that same asset at the same NOI is now down to a $10.8 million valuation. And so, as cap rates are higher, the valuation at the same NOI at the same environment is lower, and because that is the denominator.
Yep, and that's how you generate the yield that you're looking to get to compensate you for the debt. Yep.
With transactional activity, rising rates can often reduce transaction volume because of financing math works on fewer deals. Do you think that creates a more competitive landscape for operators such as ourselves, or a less competitive landscape because we also are affected by that?
Yeah, I think that's an interesting question. I think that could be an episode of itself. It is more competitive because bid-ask spreads are separated far more between what sellers are used to the last few years and where the market is. Mm-hmm. Participants are all over the board because of that, so then there's just discrepancy. That being said, transaction activity is an interesting point in itself. It's like last 2 years have been quite slow. This year started off really strong because the rates were pretty in at the beginning of the year. And I would say that it's slowed, but I don't know how much that is the rates over the seasonality that we're getting back to the normal, especially the last year and a half. It's been transitioning back to normal transaction volume, normal seasonality of how these things work. So in the summer, it does slow down a little bit, but we're still seeing a pretty good amount of deal flow. Mm-hmm. There's a lot of deals that aren't transacting because they're not meeting the sellers where they need to, and the sellers aren't ready to meet the buyers where they need to. But there is more activity, and we've been pretty successful with it. And with that, we've been able to find pricing disparity where we can take advantage of. So I think it's really quite a mixed bag, and it's really just interesting right now. Mm-hmm. But what we do is we stick to our numbers, and we look at our cost of capital, and we factor that into our analysis, and we are paying higher cap rates in most cases, unless there's a good story about how we can add value to it, like the Bend will be. That would play out that story and stuff. So
yeah, let's talk about everything in real estate. They talk about COVID, post-COVID, prices, rates, and stuff like that. How did the 2022-2024 rate cycle specifically affect real estate investing? What happened to real estate during that most recent cycle for people that maybe aren't just now getting into the investment kind of piece?
So you had cheap money in banks and Fannie and Freddie and everything else like that, and an influx. And that allowed people to underwrite any numbers they wanted to, and you could pay any price because the debt and where that cap rate was just made sense. And you only had to increase income a little bit to then get it, as long as your exit cap rate was about the same number or maybe a little higher. But when you're coming off of 4.25 or 4.5, and you just increase 75 bips, which is what most people do, to a 5.5, like that's realistic. But when they actually move there and then income doesn't increase, so rent growth doesn't happen, expenses increase way more than what you thought, all these other factors that go into it. But there was just a lot of liquidity that came into the market, right? And when you have liquidity, then you have people that are moving on it and stuff. 33%, something bigger than that, 30 to 40% of all the inventory in the States traded during that 2 to 3 year hurdle. That is not normal at all. If you did that, you would be turning over all the inventory in the United States every 5 to 7 years or so, not even. Well, 3 years if you're doing it every year, but like in that hurdle area. That's not real. That's not how apartments move. There was a lot of transactions that happened that normally wouldn't have happened or never happened because people sit on these assets for a long time. But because of the frenzy, they moved. And because of the pricing and how crazy it was. That also lends itself to the transaction slowdown, because it's like, well, if I just traded, I'm not going to trade again. But there's been this kind of like slow log of people that did buy in the front end of COVID that are on 5-year holds that need to sell now.
We talked about cap rates. We talked about valuation. I kind of want to go a little bit more into where do cap rates come from, because it's a primary valuation metric. As interest rates rise, risk-free rates also rise with that. They're correlated. Can you talk about what that looks like. If people don't understand where cap rates come from, how it's related to a 10-year treasury, kind of some of that, with a little bit of background of that when it comes to risk-free rates, interest rates, and cap rates.
Well, the risk-free rate is your underlying thing to drive your interest rate. They're not correlated, they're causated, like completely, because that's what you're basing it off of. Your spread is your bank and lender's risk metric for whatever they think. And so the component that's missing from this entire conversation and what's going on when it comes to transaction volume or rates or this, that, and the other thing is actually volatility more than it's rates. Rates can be 5, they can be 6, they can be 7%. That almost doesn't matter as much as it matters about what expectations are. Are things going up or things going down, and how long is that going to take? When you have what we've had the last 6 months of war and rates moving drastically over time, or tariffs right before that, that causes real pain. That's when transaction activity slows down. That's when spreads blow out. That's when risk in our deal from 1 month to the 3rd month of trying to acquire it goes up. That's not good. We need stability, not volatility. But to that end, with capitalization rate, I think the easiest way to back it out is that it's your yield that you're planning on doing in the investment. It's your discount rate, right? Because most of real estate for many, many years was all based off discounted cash flows, like anything else in valuation, very simplistic way. It's an easy rule of thumb, quick way to get to that same answer, that you're going to say that these things, and this is the cap rate that I'm willing to pay, and this is how I discount the cash flows depending accordingly. And because of the kind of easiness or simplicity of the real estate industry and its ability to collect debt and do all this other stuff compared to any other business endeavor, that's why there's like this kind of easy rule of thumb to look at it and say, this is what we're willing to pay on that. That cap rate, like I said, generally stratifies different asset classes, whether that's multifamily, hotels, industrial, and so on and so forth. But even inside multifamily, there's bands that it sits in. So your A-class brand new asset is going to be your lowest cap rate. And the cap rate does transact kind of like a bond too. The lower it goes, the higher the price, the higher it goes, the lower the price, as you gave in your example. But your A-class brand new asset typically is going to be your lowest cap rate. Right now, that band we've seen anywhere from 5 to 6. Your next tier of core and core plus, and that maybe is a few years older or late teens that need some renovations or some small upgrades, that will trade, 5.5 to 6.25. And then you get into your early 2000s and 90s that is true value add, or just a good kind of stabilized asset that is more workforce housing or turning into workforce housing. And that can be 5.75 to 6.5. And then just keeps going up from there.
Yeah. We've talked a lot about the risks of rising rates. Is there a scenario where higher rates are actually beneficial for real estate, or at least semi-neutral?
I think it depends on who you ask and who you talk to. It's beneficial in the fact that you're going to start buying things at yields that probably make more sense. And if you are a really good operator and can then really get into expenses and income, but really expenses and driving that, you will probably see the most upside in those kinds of deals. Because at the end of the day, if you're getting that yield, and then if there's interest rate movements over the course of time, then you can really capitalize on that at very strategic points throughout your hold period and stuff. On the other side of that, though, like, you don't want higher rates. You'd rather have lower rates that make you able to, but you're going to pay higher prices. So there's trade-offs on both sides. But I think that I think this is where we are reverting back to the mean in this case. The problem is that we have this, point in time where things got crazy. And so expectations are just so far out, and there actually has to be a lot of pain to recover from that point to get back to this kind of normalcy that we need to be at, and where yields need to be, and everything else.
Is it fair for me to say that it could also go to lend itself to reducing of new supply? So for our value add deals where there's supply constraints in certain areas, that can be a positive thing for us, because rising interest rates will also affect construction rates, which means that, ground up development might slow in certain areas, which will help with kind of supply and demand.
Yeah, but it goes back to trade-offs. Like, we do need new supply built. We have a housing shortage. We do need people to have homes, quality housing. So we do need that. We need to continue to build. And if it's hard to build, that's a problem in itself. But yes, for our demand and our rent growth factors, specifically in that vein, yes, it would be potentially beneficial depending on where it is. But people are going to figure out how to build in the good areas every time.
Yeah.
Farmville's going to continue to develop, and Phoenix and Nashville will continue to develop and stuff. So yeah.
Yeah. Let's talk about where we are now and how to think about the forward rate environment. What is your framework here as the VP of investments here when it comes to thinking about how rates are going to act going forward, both in the short term, I would say for the rest of 2026, into the next 2 years, all of 27, 28?
I tried not to pontificate on what I think rates are going to do. It's such a flexible thing. Now we have a new Fed president or chairman. And so there's a lot of flux in that environment right now. But I'm looking at it daily. I'm looking at treasury rates and yields daily. I'm looking at the SOFR rates daily on all of our transactions that we're dealing with. Monitoring that, reading news stories, keeping track of it, talking to people, and just absorbing all the information. But we mitigate it by taking on fixed rate debt and just accepting it in the timeline that we're in, right? And then remembering that, knowing that, and then looking at it going forward about, hey, okay, so if rates come in at 100 bips, 1%, okay, can we execute on this? What number is that got to be at for these 3 deals to be able to refi or recap and stuff? And keeping that in mind. But I think that there's, at this point, to go and even though I said don't pontificate, but to go that route, I do think that there's probably higher risk in the long term for rates to continue to move up from even where they're at now. I think there will be periods over the next couple of years where they come in, but I do think they're pretty much where they're going to stay at for a while. And I think there's, again, greater risk that they actually increase further, depending on what's going on. And then the only reason that they're going to go the other way is because we experience real pain in the fact of a recession or some sort of economic event that is not good and will be outweighed by whatever rates do. I think there's growing sentiment right now that actually in a declining rate environment, that's not necessarily bullish and good for real estate. And that's true because, again, outside of COVID, when we cut rates, it usually means there's bad things going on. So then the American consumer is not ready and prepared for whatever those things are to be able to capture it and stuff. And we do have a debt problem. So we'll see. But we just try to take risk off the table by underwriting conservatively, looking at the landscape of where the markets are right now, putting in upside downside on those rates during the time that we're trying to close the loan. And then when we close the loan, taking on fixed rate debt that takes away that risk during the term of the deal.
Over the past 2 episodes, we've talked a lot about which questions passive investors should ask, or at least what fact-finding things that they should check off when looking at a deck or evaluating an operator. We talked about asking or finding out if the debt is fixed or floating. We've talked about what leverage is being used. There's almost always leverage being used, so how much of the capital stack that is. We always put that in the model and in the deck. What does the return look like? What does the deal look like, in a flat versus rising rate scenario? The operator's track record, we've talked about that in other episodes. But also I think a big thing to ask is, and we haven't maybe mentioned this before, is what is the exit cap rate assumption? A lot of people do ask about the entry cap rate, but a lot of people maybe forget to ask about the exit cap and what that sensitivity analysis is. What is our base case? What's optimistic? What's pretty moderate, and what's super conservative there? That's a slide that we include because is it actually conservative relative to the current market conditions, or is the deal underwritten to exit at a lower cap rate than today's market that requires the rate to improve a lot, not just based off of like where everything is trending? So I think that was an important conversation that people should have with the IR person, or at least analyzing the deck. Do you think that there are any additional questions that people should ask with the way that rates are going and the way that rates affect real estate investment performance?
You ask them kind of what we've been talking about, just how they think about it and how they're mitigating for different risks. And then I would ask them, like, what do they think about rates? And if they pontificate and tell you that they think rates are going to go down, you probably want to really have a second thought about it. Mm-hmm. That's what people have been saying for 3 years now, since 23 when it started to go up. Rates are going to come down. They haven't. So that, just because someone wishes it and thinks like that's, if they are very confident in where they think rates are going and they don't caveat it with, well, we don't really know, because we don't, and there's a lot of factors that go into it, I would be a little bit more nervous of those people. And there's been tons of them, right, that are just overly confident about where things are going to go and where they're going to end up. And they're very wrong. They've been wrong this whole time. In the same way, and try to predict what the Fed's going to do with cutting rates. And even then, the Fed's influence over what rates are is getting very limited more and more day in, day out. Their impact is on the short term, and to that point, it's gotten better, which is why now, going back to that variable versus fixed, it's like if you take on SOFR variable, your rate's going to be 50, 60 bips lower just from doing that.
Yeah.
So
Well, I think that like we've covered a lot in kind of debt structure, what the rates are, how the rates affect the deal, and then from an interest only period, and then what that interest rate actually does to the deal. Our next episode will actually be talking about what the leverage piece of it, and specifically negative leverage, what happens when you have negative leverage, and how to respond to it, and how passive investors can understand what negative leverage is. But thanks so much for your time today, and always a pleasure to have you on, and looking forward to our next episode.
sounds good.
Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.